It is Friday, April 17th, 2026, and the S&P 500 index has officially crossed the historic 7,000-point threshold. This momentum pushed the index to an intraday high of 7,008, a rally supported by resilient corporate earnings and optimism over diplomatic talks in Tehran. But zooming out from the trading floor, that optimism collides with a harsh physical reality. The global economy is currently absorbing a massive energy supply shock triggered by the ongoing conflict between the US, Israel, and Iran. A physical and military blockade of the Strait of Hormuz is restricting critical maritime traffic and anchoring Brent crude oil near $99 a barrel. Because expensive oil feeds directly into consumer prices, the Federal Reserve has abandoned its earlier expectations for interest rate cuts. Adding immediate pressure to this equation, the temporary US-Iran ceasefire is set to expire this weekend. This creates a clear contradiction. How are cash equity indices hitting all-time highs when the underlying macroeconomic conditions have become so restrictive? This rally is operating under a fragile growth over margin paradigm. Investors are betting that artificial intelligence will outpace inflation, even as institutional capital shifts toward protective strategies in the derivative markets. To see the scale of the macro headwind, we have to look at the maritime bottleneck. The Strait of Hormuz is responsible for the transit of roughly 20% of global oil consumption. When supply is restricted, price increases bleed into domestic data. Last month, crude prices translated into the largest U.S. consumer price increase in nearly 4 years. This creates structural stickiness in inflation, neutralizing earlier models that priced in monetary easing. Federal Reserve officials have publicly acknowledged this shift. The presidents of both the San Francisco and St. Louis Feds have unified around a restrictive posture. Their projections show underlying inflation remaining nearly a full percentage point above the 2% target for the entirety of 2026. With a heavy docket of Fed speakers taking the podium today, the market expects them to reinforce this policy stance. Institutional participants have largely internalized this. They are no longer positioning for cheap borrowing costs in the near term. In a structurally expensive capital environment, investors are moving capital out of vulnerable sectors and into companies that can prove they are resilient to these cycles. That search for resilience leads directly to the semiconductor sector. It is the primary reason equity indices have been able to ignore the Fed's pivot. Look at Taiwan Semiconductor's Q1 2026 earnings. Net revenue surged over 40% to $35.9 billion. Even more telling is their 66.2% gross margin. This proves demand from clients like NVIDIA is inelastic. They're paying whatever is required to secure hardware. To support this demand, TSMC deployed $11.1 billion in capital expenditure in just 3 months, front-loading the construction of new 3-nanometer facilities. In contrast, sectors like European luxury are seeing sales collapse as Middle Eastern demand dries up and energy costs squeeze consumer spending. This divergence is forcing a geographic rotation of capital. This week, Taiwan's total equity market capitalization reached $4.14 trillion, surpassing the United Kingdom's for the first time. The AI bid is powerful enough to override domestic risks. Japan's Nikkei hit an all-time high this month, despite the country importing nearly all of its crude oil. Capital is moving away from traditional financial and industrial hubs and toward the jurisdictions that control digital infrastructure, effectively decoupling these tech giants from the broader macro cycle. While tech drives the index level, the market's internal plumbing is undergoing a shift today. The SEC's official elimination of the pattern day trader rule takes effect. This removes the long-standing $25,000 minimum balance requirement for active day trading, lowering the barrier for millions of smaller accounts. Brokerages like Robinhood are the immediate beneficiaries, with their stock surging 10% on the regulatory news. Since the majority of these users are millennial and Gen Z investors, this change significantly expands the volume flowing through payment for order flow models. This new wave of retail capital is expected to target highly speculative, short-duration options. When retail volume spikes in these contracts, institutional market makers are forced to hedge their positions, potentially amplifying price swings. This influx of frictionless retail liquidity introduces a new variable into market plumbing, adding another layer of potential intraday volatility and the threat of options-driven gamma squeezes. While retail liquidity and AI demand push headline indices up, a look at institutional positioning reveals a more cautious perspective. Professional money managers face a dilemma. They must hold these tech stocks to keep pace with the S&P 7,000 rally, but many are simultaneously paying for protection against a sharp decline. This is visible in today's options volatility stew. The persistent preference for put options in the 7,020 range shows institutions are aggressively buying downside insurance. Prediction markets show a similar split, with investors using opposing no contracts to hedge their portfolios. They are hedging against a specific event, a failure in the ceasefire talks currently being mediated by Pakistani officials in Tehran. Surface-level volatility metrics look calm today, but the underlying structure of the options market suggests large players are taking the threat of a weekend breakdown seriously. These all-time highs on the cash indices are accompanied by an unprecedented volume of protective positioning, signaling an institutional consensus that is taking no chances with the weekend's geopolitical developments. Entering the Friday session, the market is betting that the productivity gains from the AI cycle will be strong enough to absorb the friction of $99 oil and high interest rates. If there is a definitive diplomatic breakthrough this weekend that extends the ceasefire, the energy risk premium could evaporate, clearing the way for this tech-led bull market to continue its climb. But if the negotiations fail, we are likely to see a further spike in energy prices and an intensification of the regional blockade. That would force a destructive repricing of the inflation narrative, testing the psychological resilience of the equity market. For corporate leaders, this environment requires scenario-based modeling. CFOs are being advised to establish 24/7 crisis management desks and prioritize energy storage strategies. For investors, the recommended path is a barbell strategy. Keep exposure to the core AI infrastructure while maintaining hedges against discretionary sectors vulnerable to energy costs. Navigating this market requires a balance, tracking the momentum of technological supercycles